So, guys, welcome to lesson 4 of financial reporting and analysis. So, for this lesson 4, we shall concentrate with a question where we just have a balance sheet. So, where we have a balance sheet, so we shall do some of the question where we have a balance sheet. Then later, we shall do a question where we have balance sheet and the income statement, or the income statement alone. So, we shall start first with a question where we have a balance sheet. Then we familiarize with such kind of a question. Once we do the one which has balance sheet, we do also do another question where we have only the income statement alone. Then once we do a question where we have the income statement alone, then we can look for a question where we have both the income statement and the balance sheet. This kind of a question usually more than 15%, 15 marks. So you can find this a question is 15 marks, or where we have both the income statement and the balance sheet, it is full 20 marks, just one question. So it's a very, very important question and you need to understand it very well. So let us do the question for August 2025. August 2025 will be our first question. The one that was done in the last sitting. So just last sitting, it was for August 2025. August 2025, question number 3. The question is about Pool Limited. It's about Pool Limited. So let us do the question. Let us read the question together. And this is what it's saying. On 1st January 2024, Pool Limited acquires 80% controlling interest in Sharp Limited when the retained earning of the Shape Limited amounted to 3.2 million. The acquisition consideration considered an immediate cash payment of 12 million Kenya shillings on 1st January 2024, and a further cash payment of 12.1 million deferred until 1st January 2026. Pool Limited cost of capital is 10%. Now that information is very important, the last information. When we talk about the deferred cash payment or cash payment deferred, the cash payment deferred must be discounted back to present value, that is financial management. So you know the formula for discounting back future value to present value. So remember that 12.1 million to be paid in future in January 2026 is supposed to be deferred cash payment. And therefore, we need to discount it to present value today. So now accounting entries has been made in respect to the deferred cash consideration. So we need to make an adjustment for that. So we need to make an adjustment for that. It will be a current liabilities, the settlement of the financial position. It will be a current liability once we make an adjustment. And also, we shall consider it when computing goodwill, because it's part of purchase consideration, but we shall consider it once we convert it to present value. That one is okay. The first company that was acquired, that's the Shape company, because it is more than 50%, more than 50%, it is a subsidiary. Then number 2, go to the next company. Pool Limited also acquired 50% of the equity interest of Jolty Limited and obtained a joint control of a Jolty Limited on 1st January 2024. The purchase consideration comprised of an immediate cash payment of 10 million on 1st January 2024. The retained earning of Jointry stood at 2.5 million on 1st January 2024. Now, Pool Limited also acquired another company which is called Jointry. That company is a subsidiary, it's a joint venture, because the company acquired exactly 50%. So when 50% of the shareholding is acquired by the parent, then that company becomes a joint venture company. So we have the following are a draft of the statement of the financial position for the 3 companies. So we have the statement there. We don't need to go about it. Now our interest will be on the additional information. Our interest will be on additional information. But before we go to the additional information, number 1, let us complete the working above. Let us complete the workings in the workings above. Now, for us to do those workings above, before we go to additional information, we need to check when does this financial statement end. Now, this financial statement ends in that 1st December 2024. So you need to check that one even before you continue. So we need to draw just this one is for illustration purpose. In an exam, also make sure you do this. So it ends 31st December 2024, meaning the statement starts in 1st January 2024. Now, let us go back to our statement above. The first one, it says, on 1st January, Pool Limited acquired 80% controlling interest of Sharp. Now, Sharp was acquired at the beginning of the year. So, Sharp acquired. So Sharp was acquired at the beginning of the year, meaning the Sharp Limited was there throughout the year. So we don't have pre-acquisition or post-acquisition in that case. Within the financial year. So, but we have a pre outside the financial year. Outside the financial year. So from December 2023 moving backwards, that's a pre-acquisition. So this company was not there Sharp, but from 1st January to the end of from the financial year, when the financial year started up to the end, that is the post-acquisition, and the company was there throughout. So the company was there throughout. So Pool acquired Sharp 80%. Meaning what's the NCI? The NCI is 20%. The NCI is 20%. So this one is 80%. We put it on this side. 80%. Also, Sharp acquired another company. That is called Joltry. Joltry Limited. And it was acquired 50%. 50%. That is a group structure. So meaning that Sharp is a subsidiary. So this one means that Sharp is a subsidiary, and Joltry is a joint venture. Now, and another thing that we have noticed is that Sharp was there throughout the year. It was acquired at the beginning of the year. So meaning from the start of the year, this year 2024, up to the end, this company was there. So it was not acquired any time within the year. It was not acquired any time within the year. Let's talk about the purchase consideration. So purchase consideration in this case is made up of 2 items. So purchase consideration. Number one, it is made up of number one, the immediate cash of 12 million, I think. Immediate cash payment of 12 million. Then you have deferred cash payment. Cash payment. Now the deferred cash payment, they said, let us go back. On 1st January 2024, Pool Limited acquired 80% control interest limited, where the trading of Sharp Limited was 3.2 million. The acquisition consideration consisted of the immediate cash of 12 million, that is correct, and 12.1 million. 12.1 million. So this 12.1 million, we need to convert them to present value because it is a deferred. So as I said, the International Accounting Standards requires that when you have a deferred cash payment in the future, that future value must be converted to present value so that we can get the total cash consideration. So how do we do it? So 1.2. The cost of capital is 10%. You know the formula. Tasemanga present value is equal to future value 1 plus R raised to minus n. So R is the cost of capital, and we have the cost of capital. Now we are in 2024. How many years up to 2026? So that we can convert from 2026 to 2024. So that is 2020. That is 2 years. That is 2024 and 2025. And this is at the end of the year. Remember, this one is at the end of the year of 20. So we are saying it will pay when? Let us see when it will be paid. it will be paid on 1st January 2026. 1st January. And remember, we are in 2024. 2024, 1st January 2024. And we are supposed to go up to 1st January 2026. So this amount will be paid in 1st January 2026. So it will be there through 2024 full year. So and then 2025 also it will be there. 2025 the whole year. So kumaanisha this one 2025. So the whole. But in 2026, because we shall pay at the beginning of the year, it will not be there. So by the end of 2025, we are supposed to pay this amount of cash deferred. So it will be there for only 2025, 2025. How many years is that? That is 2 years. So let's do that working. Pick your calculator. So we say 12,100 1 plus 0.1 raised to minus 2. That is 10 million. That is equal to 10 million. Then we add to get the total purchase consideration. Total purchase consideration. Purchase consideration. So plus 12 million. That is 22 million. So this is the total cash consideration. That is the total cash consideration. So remember our figures, it's in thousands, so we shall convert this one. While we're doing our working, we shall convert that 22 million into cash consideration into thousand. Now that's the work that we were required in the first and the second paragraph, nothing more, nothing less. So we can go to additional information number 1. Additional information number 1, and remember this additional information is what we said comprise of the adjustments. Remember the adjustment that we did in lesson 1 and 2? All those adjustments is what now we shall be doing here. Let's start with additional information number 1. As at the date of acquisition, the fair value of Sharp Limited net asset approximated their carrying amount, with an exception of some plant whose fair value was 1 million above the carrying amount. So when something is above carrying amount, that is revaluation. So when you see something that the fair value was more than the carrying amount, remember revaluation. Remember revaluation is equal to fair value minus carrying amount from our previous question. Now, when the fair value exceeds carrying amount by 1 million, that's the difference between. So that 1 million is the difference between fair value and the carrying amount. So in this case, we were given directly the fair revaluation of Kenya shillings 1 million. So we know we have a revaluation of 1 million. That one, remember, it will affect two accounts. It will affect what we call the PPE account, and then also it will lead to something else. It will lead to something which is called depreciation under charge. So we need to compute depreciation under charge. So I will just compress because of space. Depreciation under charge. So do we have useful life? Let us continue. At this date, the plant had remaining economic life of 5 years. So at this point, at this date, the plant had economic life of 5 years. Had economic life of 5 years. So you need to know that one. So 1,000 divided by 5. So remember, for you to get the depreciation under charge, it's equal to revaluation divided by the number of economic life, number of years of economic life. If you don't have the economic life, you can be given depreciation rate. So revaluation times depreciation rate. So in this case, we were given economic life as 5 years. So how much is that? You are given economic life as 5 years. So that is 200,000. 200,000. So this is information number 1. So we shall do adjustment later. We shall do everything later. Or let us just do what is necessary. Yeah. That is all about the information number 1. Let us go to information number 2. Pool Limited measure goodwills and non-controlling interest using the fair value method. Now, when you see that the NCI is measured on fair value method, then you need to know that that is full goodwill method. That is full goodwill method. So I think we need to do that one. Full goodwill method. Now, now in this case, let us compute goodwill. So information number 2 is all about goodwill. Goodwill. Now, because we are talking about the NCI, so we can do for the parent and we can do for the NCI. So we start with the purchase consideration. Purchase consideration. The purchase consideration, we put them in thousand because now we are working. So the purchase consideration was 22 million. So in thousand is 22,000. Now what about the fair value of the NCI? The fair value of NCI. Let us look for the fair value of the NCI. The fair value of the NCI. Okay, yes, that one is fine. So information number 2. The Pool Limited measured the goodwill and non-controlling interest using the fair value method. The fair value of the non-controlling interest was 5.7 million at the date of acquisition. So it was 5.7. So fair value of NCI. Fair value of NCI. It was 2.7. 5.7 million. So that's 5,700. Then we are supposed to list the net assets. So we list share of net asset acquired, share of net assets acquired, the share of the net assets acquired. So we start with the ordinary share capital and share premium. Ordinary share capital and share premium. So ordinary share capital and share premium. Now ordinary share capital, let's go to our balance sheet. When you go to our balance sheet, you can see that the ordinary share capital for Sharp Limited, Sharp, the company that is being acquired, it is 20,000. It is 20,000. So the parent control 80%. So the first one it will be 80% times 20,000. So how much will the parent take? So 0.8 times 20,000. That is 16. And then 20% goes to the other company. So 20% of 20,000, that is 4,000. 4,000, that is correct. We go to the share premium. Share premium to the balance sheet, it is 2,000. So 80% of 2,000. 80% of 2,000, how much is that? So 0.8 times 2,000. So 80% goes to the parent. The other one goes to the NCI 20%. So 20% of 2,000, that is 400. Now the rest of items that we need to put here, we need to put them as at the date of acquisition. As at the date of acquisition. So we have the retained earnings and we had a revaluation somewhere. So we had retained earnings and revaluation. So let us go back to our question there at the beginning. So question 3 at the beginning. So on 1st January 2024, Pool Limited acquires 80% of controlling interest of Sharp Limited when the retained earnings was 3.2. So the retained earnings now is 3.2 at the date of acquisition. So as the date of acquisition. So 80% of 3.2. So how much will go to the parent and how much will go to the 0.8 times 3.2? That is 25 something, 2560. 25, 60. Now, what about 20% remaining? That is 640. You also have revaluation somewhere. Revaluation. Also, as at acquisition, as at acquisition. Now, as at acquisition, that is information number one. Let's go to information number one. Addition information number one. Now, as at the date of acquisition, the fair value of Sharp Limited net asset approximately the carrying amount, with the exception of plant whose fair value was 1 million or above the carrying amount. 1 million above the carrying amount. That we have it here. This revaluation occurred during at the date of acquisition. So the buyer take 80%. 80%. That is around I think 800. This one will take 200. Now the difference you get the total goodwill. Total goodwill. There was no impairment in the question. Let me check if there was anything to do with the impairment. There was nothing like impairment. Information number 4, let's read information number 4 together. Impairment review performance on that first August 2024 revealed that the goodwill arising from Sharp Limited had been impaired at an extent of 20%. So there was an impairment. So there was an impairment actually. So we need to make that impairment. Okay. There was an impairment. So we shall account for that one. So, but before we account for that one, let us find the total goodwill before we account for impairment. So 22 million minus 16 minus 1600 minus 2560 minus 800. This is 1040. Then you have 5700 minus 4000 minus 400 minus 640 minus 200. This is 460. 460. 460, that one is correct. Then there was an impairment of 10%. So impairment, we say that one goes as an expense. 10% of that amount. So 10% of 1040. So it was an apparent impairment. They said it's 10%. So 10% of 1040. That is 104. And 10% of 460. 460. That is 46. So meaning net goodwill. Net goodwill will be equal to 1040 minus 104. This one is 936. And then for 60 minus 46, that is 414. So total goodwill, you can find total goodwill. So total goodwill of that of the company and that of subsidiary is 1350. So that's the net goodwill. That one, which is an asset. This one is considered as an asset. And the other one, the impairment, total impairment, 104 plus 46, it is considered as an expense. It is considered as an expense. It is considered as an expense. That one is okay. So we are done with the information number one. Now, before we continue, let me show you another way you can do this question, this item. Just some small working here. The first one, you start with the purchase consideration. Another format. If you find it good, you can use it. Then the fair value of the NCI, which is 5700. Then you less net asset. Net asset acquired. So we start with the ordinary share capital, for example, share premium, retained earnings, and revaluation. Remember these two as at acquisition. Remember that was acquisition. So you put the full amount. For example, this one, ordinary share capital, it is 20,000. 20,000. The other one you put is 2,000. Then the other one is 3,200 as the date of acquisition. Then the other one is 1,000. So you get the total goodwill. capital goodwill. So if you find it, let us see 22,000. Let us see 22,000 plus 5,700 minus 20,000 minus 2,000 minus the 200 minus 1,000. You get something to do with 1,500. This is another way you can do it. If you don't want to calculate the goodwill for the NCI, then we less impaired, which is 10%. 10% of this one is 150, so that you can get the net goodwill. Net goodwill. So 1,500 minus 150, that is 1,350. So that is another way you can do that question. Haraka haraka. That's another way you can do it. So you take the purchase consideration, you add the fair value of the NCI, then you less the net assets. You can get it. There's another way you can do it. Let me just show you. But I will not use that method in most scenario because of time. But let me just show you. You open the COC account, cost of control account. So you open the COC account. You open the COC account. So those who love opening T accounts, but it is time consuming. So you open the COC account for the parent, COC account, cost of control account. We call them the cost of control account. So cost of control account, cost of control account. Let me check just a moment. So cost of control account. So we open. So we say cost of control account. So we start with the pool limited. So we start with the purchase consideration, which is 22,000. Then we less the net assets. So we start with the ordinary share capital. So we pick 80%. That is go to the parent of 20,000. Tunaweka hapo. Share premium 80%. That is goes to the parent 1,600. That is 400. Retained earnings. Retained earnings, remember, as at the date of acquisition. Retained earnings, remember, as at the date of acquisition. As at the date of acquisition. Then revaluation reserve. Revaluation reserve 1,000. That is 800. Then impairment, if there is an impairment, so that you can get your goodwill. So you balance that account. Remember, their balance is supposed to be 22,000. So the balance is supposed to be 22,000. So what you do, you pick 22,000, you less 16,000, you less 400, you less 2560, then you less 800. So this amount that 22,000 minus 16,000 minus that's 8% of 2,000 is 1,600. So plus 1,600 minus 2560 minus 800. So it is giving us something to do with, what's wrong with this item? Sorry, 22,000 minus 16,000 plus 1,600 minus 2560 minus 800. It's giving us an amount. I think my calculator is not doing well because 16,000 Let me just add them direct. 16,000 plus 1,600 plus 2,560 plus 800. That is 2960. Then I take 22,000 minus answer. I'm getting 1040. Yes. So when you take 2,000, so we have to get the balancing figure. These two balance. So I'm getting 1040. Now this 1040 is the total goodwill, but remember there was an impaired goodwill from the question of 10%. So we need to cater for that. It is 10%. So 10% of this amount, the balancing figure, is equal to 104. And therefore, so 1040 plus 104. So out of this one now you can get your goodwill. Now once you get the impairment, you can get your goodwill as 936. When you add them together so that you get 22,000. You also do the same for the NCI, cost of control of NCI. So as normal, you start with the fair value, which is 5,700. Then ordinary share capital, share premium, retained earnings, and valuation reserve. And then if you have the pre-acquisition dividend, but with this kind of equation, the dividend was not acquired within the year, so there's no dividend. So this one is 4,000, 20% of 20,000, then 400, 20% of 2,000, then 640, and 200. Then you find the balancing figure, 5700, 5700. So when you take 4,000 plus 400 plus 640 plus 200, you get amount of 5240. Then you take 5700 minus answer, you get 460. Now 460 is combination of impairment, because we have the impairment loss and the goodwill. So out of this 460 balance, first we know 10% goes to the impairment, that is 46. So you balance the account again so that you get goodwill as 414. So this is the cost of control account which you can use to do this account. Anyway, that one being said, we can continue with the information number. So number 1 we have done it, number 2 we have done it. We go to number 3, information number 3. During the year ended at 1st December 2024, Shape Limited sold goods to Pool Limited for 4.5 at a markup on cost of 25%. A third of the goods were still in the Pool Limited as at 1st December. The balance payable was still owing, so it was not paid. So the balance was not paid. So let me do away with this one. Go to information number 3. Information number 3. Now this one is about unrealized profit. Unrealized profit on stock. And how do you get it? Unrealized profit on stock. We take the unsold good times profit margin times profit margin. Now let us compute the profit margin first. Now profit margin. Now if we have the markup, the margin must have a wide base. Magario makubwa. Yes. Now it is 25%, so the markup is 25%. Now, if the markup is 25%, it means it's 25% of 100. Now, how do we make this margin to have a big Macario? So you take 25% over, so we add 100 to 25%, so that the base becomes bigger. So meaning our profit margin is equal to 25 over 125. So we can say that our UPS is equal to 25 over 125 times unsold goods. Now, goods that were sold was 4.5. I'm putting it in thousand. So these were the goods that were sold, but how much were there? Remained in the market. So a third was unsold. So a third was unsold. So a third was unsold. So that call them the UPS. So 25 over 125 times 4500 times 1 over 3. I'm getting a figure of approximately 300 Kenya shillings. So this is the UPS. So it must be eliminated. It must be eliminated. So that one must be eliminated. That one must be eliminated. I think that one is okay. That one is okay. We can go to the next information. The next information is information number 4, and we have covered it. So information number 4 is about the impairment. The information number 4 is about the impairment. Now, with that information, now let us compute the goodwill. So required number 1. Let us go to information number 1. Required number 1. Required number A. Calculate the value of the goodwill arising from the acquisition of Sharp Limited. 6 marks. We have it here. So this is the goodwill. 6 marks. Is the answer. You can use this method that I have used it here, or you can use the other method where you can just combine it as a whole. Purchase, you add the 5700, then you put the other amount as a whole figure without the proportion, if you do it as a whole. Or use the control account if you want to open the T accounts. If you want to open the T accounts, use the cost of control account for NCI and for the main company. Number B, calculate the value of interest in jointry. So this is what we call the investment in. So let us do number B, investment in associate. So you be very keen here. Now for investment in associate, we use equity method. For you to calculate the interest in associate, to calculate interest in associate, we use equity method. Equity method. We use the equity method. So we use the equity method. Let me give you the formula. Let me give you some notes on equity method before even we continue. The equity method. Where is it? Equity method. That one I think you shall need. Now I will not give you the whole notes, but the whole notes I'll give you later. But for now, there is something you need to know. So under associate, we have two methods for computing the investment in associate. We have two methods. So we have two methods, option A and option B. Let us start with option A. So for option A, we start with the cost of investment or the purchase consideration. Cost of investment. Remember the word cost of investment is the same as purchase consideration. Is the same as purchase consideration. Then we add parent share post acquisition profit. Parent share post acquisition profit. Then we less goodwill. Then we less goodwill impaired to date. Then we less share of URP. Share of URP in closing stock. In closing stock. So we less this amount. So you shall get the investment in associate. Investment in associate. Then you have another option, option B. Option B. So we start with parent share of net asset. Parent share of net asset. Of net asset. We add goodwill unimpaired. We add goodwill unimpaired. Then we less the share of URP on closing stock. On closing stock, we shall get the same figure as the investment in associate. Investment in associate. Now, parent share post acquisition profit. How do you get the post acquisition profit? You take the retained earnings at the beginning minus the retained earnings at the end. So when you talk about post acquisition profit, post acquisition profit, you know it is the retained earnings. You know it is the retained earnings. Retained earnings at the end minus pre-acquisition profit. Pre-acquisition retained earnings. Pre-acquisition retained earnings at the date of acquisition. This one is at the end in our balance sheet. Now let us try and see if we can do it. Now from this question, let us go back to our question. What is the cost of investment? What is the cost of investment of the associate? So the cost of investment for the associate, you go to our balance sheet. Let's go to our balance sheet. Now if you go to our balance sheet, we have the PPE, that is for the three companies. Then you have the investment that the pool company has done. So you go there. Now for the pool investment, if you go under investment, we have the Sharp. They told us that the investment that was done was 12 million, and you can see we have it here. 12 million, we have it here. The 10 million is not included in that balance sheet because it was a deferred payment. Then we have jointly limited. When you see jointly limited, we have 10,000. 10,000. Now that 10,000 is the cost of investment or the purchase consideration. So we put here 10,000 in our balance sheet. Let us do it in thousand. Now acquisition profit, as I said, you take the item in the balance sheet minus from the date of acquisition. Now let us go to the jointly limited. Let's go to the jointly limited statement. Then you go to the retained earnings. So if you go to the retained earnings, you can see that the retained earnings for jointly limited, because we're talking about jointly, because that is the associate company, it's our associate. It is 3,800. That is the retained earnings at the end. Then we less at the beginning. At the beginning is on the second paragraph at the start of the question. Let me read. Pool Limited acquired 50% of the equity interest of Jollity Limited and obtained a control over Jollity Limited on 1st January 2024. The purchase consideration and an immediate cash payment of 10 million was made. So already had a company. The retained earnings of Jollity Limited was 2.5. 2.5. 2.5. Then we need to put the parent share. So how much is the parent taking? So the parent is controlling 50%. So how much will be the company take? Let me just formulate again. It will be 50% times 3800 minus 2500. So the parent share. The parent is taking 50% because it is controlling 50%. So the parent share of post-acquisition profit. So post-acquisition profit retained earnings at the end minus pre-acquisition. Pre-acquisition means at the date of acquisition. So 3800 minus 2500 divided by 2, which is 50%. This is 2600. Less the goodwill impaired. We less the goodwill impaired. That is information number 4. Information number 4, they said impaired reviewed performance on that 1st December 2024 revealed that the goodwill arising from the acquisition of Sharp Limited had an impaired of 10%. The interest in jointry was unimpaired. So this one, there is no impairment for jointry. For Sharp, it was 10%. For this one, they said there was no impairment, so it is 0. URP, let's go to URP. That is information number 3. During the year ended at 1st December 2024, Sharp Limited sold goods to Pool Limited for 4.5 million at a markup cost of 25%. A lot of the goods were still in the store, and then the balance payable was still outstanding. Now we have not been told that at any point there was any transaction of goods between the parent and the jointly. It is only that the intergroup sales occur between the Sharp Limited and the pool, Sharp and the pool. But between jointly and the pool, there was no any sale of goods. And therefore, in this case, we don't have URP. In this case, we do not have the URP. Now, find the final figure, investment in associate. Investment in associate. So itakuwa ni how much? Investment in associate. This one is 650 actually. Sijui nimetoa wapi hizi figure. This is 650. So 3800 minus 2500, that is 1300 times 50%, that is 650. Then we add 10,000. That is 10,650. 10,650. So that's the investment in associate, and that investment in associate is treated as asset. So it is treated as assets. So that one is all about it. 10,640. Then information number 4 also, there is something else. Information number 3, there was a group owings. So in the group balance, intergroup owing. Now intergroup owings is this amount. Where is it? 4.5. Reason why? Because they said the goods that were transferred, they were not paid for. So at the end of the year, so at the statement ends, they said, let me read information number 3 again. During the year ended at 1st December 2024, Super Shape Limited sold goods to Pool Limited for 4.5 million. So they sold goods for 4.5 million. That one is okay. At a markup of 25%. A lot of the goods were still held by the Pool Limited at 1st December, and the balance payable was still outstanding, meaning this amount that Pool sold. So Shape sold goods to Pool at a cost of 4.5 million. By the end of the year, this amount was still outstanding, was not paid. So walichukua goods lakini hawakuwa wamelipa. So these owings must be eliminated. It must be eliminated. We must eliminate it. So it must be eliminated. I think that up to that point we are done with all the additional information, and now we can prepare the statement of financial position. I think we do it in the next 10 minutes. The next 10 minutes. So let us do this working. So remember, when we talk about consolidated statement of the financial position, we pick the one for the parent and the one for the subsidiary. So let us go to our statement of financial position. Let's have the PPE. So the PPE for the parent was 36,400. 36,400. 36,400. We add that one of the subsidiary. That is 18,500. And remember, don't add the one for joint venture or associate. So you ignore for joint venture and associate. Then we had the valuation somewhere. There was a valuation of 1,000. Here it is. So we had a valuation of 1,000. Then you had a depreciation under charge. So depreciation under charge is supposed to affect this account also. So the valuation increases the PPE account. So we add with the 1,000. But the depreciation under charge will reduce this account by 200. It is in 1,000, so we put it in 1,000. How much is that? 36,400 plus 18,500 minus 1,000. So not minus. Supposed to be 1,000 minus 200. 55,700. So that one is 55. 55,700. So in 1,000. Number 2, goodwill. This one requires a working, but we did the working anyway. This one requires a working. So that working is 1,350. The working is 1,350. working was 1350. Then investment in jewelry requires a working also. This one requires a working. In the working we have done it. The working we have done it is 10,650. 10,650. That is over. So let us go back to our statement. So in our balance sheet, the first item is PP. We have managed to take the one for the parent, that is the pool limited, and the one for the subsidiary, that is the Sharp. Then investment. So investment in Sharp, that is the investment in subsidiary. So investment in subsidiary will be replaced by the goodwill. So investment in subsidiary will be replaced by the goodwill. Then investment in jewelry will be replaced by the investment in associate. So investment in associate, that is the investment in jewelry. Now let's go to inventory. Let us go to the next item. Now inventory for the parent is 2,400, 21,400, 21,400 plus 21,400 plus 13,000 plus 30,000. Then there was a URP, UPS, not use UPS, unrealized profit. This one of 300. Now we need to eliminate it. So how do we eliminate it? We deduct it there. That's how we say we eliminate. So 21,400 plus 13,000 minus 300. That is 34,100. So remember the entries that we were doing in our first class and second class. So that's the entries, adding, deducting, adding, deducting. So we debit this account, we credit this account. If you understand also in this part, then it will be okay. Then you add the receivables. Receivables, we take the one for the group, the parent, 18,000 plus 11,400. Then we take any owings that was there. So it must be eliminated. So intergroup owings, it was 4,500. So we need to eliminate the intergroup owings immediately. So 18,500 plus 11,400 minus 4,500 is supposed to be 25,400. 25,400. Cash and cash equivalent, there was no any account affected cash and cash equivalent, so we take it direct. 12,700 for the parent and subsidiary. 12,700 plus 80,100. 80,100. So 12,700 plus 81,000. That is 2,800. 2,800. So we can get our total assets. So our total assets will be equal to 55,700, 1350, 10,650 plus 34,100 plus 25,400 plus 2,800. I'm getting around 148,000. 148,000. That one is correct. Now for the ordinary share capital, we take the one for the parent, for ordinary share capital alone. So pick P alone, parent, and also for share premium, you pick the one for the parent. That is the pool company. So for pool, we have 50,000. 50,000. And we have 5,000. Retained earnings requires a working. We have not done a working for this one. So for now, you shall allow me. NCI requires a working. We haven't done a working for that one. So we shall do a working for the two item. Long-term borrowing. Let us go to long-term borrowing. So long-term borrowing, it was two items. The one for the parent and the one for the group. 18,000 and 8,500. 18,000 plus 80,500. So how much is that? 18,000 plus 80,500. That is 26,500. 26,500. We can get total equity here actually, but we cannot get it for now. Reason why? Because we don't have the retained earnings. We don't have the retained earnings. So, but at the moment, itakaa hivyo. Trade payables. So trade payables, we need to check on trade payables. 16,300. 16,300 plus 16,300 plus 9,500. But remember, we had an owing, so we debit and we credit those two accounts. receivables. So Owens must reduce the receivables account by that account, and also reduce this account by the same amount. So that's how you eliminate the Owens. So itakuwa ngapi? 16300 plus 9500 minus 4500, 21300, 300. We have the current tax in the question. Current tax is 85 and 49. So 85 and 49. So 8500 plus 4900, that is 13400. Then you had a deferred consideration. It was of how much? Deferred consideration, it was of 10 million. So that is 10,000. It was of 10 million. But remember, we need to add the interest. So this one, this is what we say the deferred consideration. So it's a liability to the company. So remember, it's a liability because they are not paid. But also you need to add the interest on that account. So 10% of 10,000. So that we get the total. So 10,000 plus 10% times 10,000. That is 11,000. So that you can get our total equity and liability, which is supposed to be 148,000. So we need to prepare two accounts. One is the NCI, the other one is the retained earning account. We start with the NCI. We can start with the we can start with the NCI account, then we do retained earnings later. Start with the NCI. So remember, for the NCI, we can use the proportionate method, or we can use the other method. We can use the proportionate, or we can use the other method. So I think any method is applicable, but I'm going to use the fair value method because we have the fair value. Since we have the fair value, let me not complicate items. But if we find a question where we don't have the fair value, we shall use the proportionate method. So NCI. So NCI, I niliwapea two formulas. I remember I gave you two formulas for calculating the NCI. One was the one for proportionate, and I did two format. So I'm going to use the one for the fair value. For the fair value. So fair value, it was 5,700. It was 5,700. This one, the fair value. Then post acquisition profit. You need to take account post acquisition profit. Post acquisition profit is supposed to be, remember the NCA was 20%. It's supposed to be 20% of the, remember the acquisition profit is the retained earnings at the beginning, you less the pre-acquisition retained earnings. So let's see the retained earnings at the end. The retained earnings, the retained earnings for at the end for the Sharp Limited was, we go to the balance sheet, 6,100. Then what about the at the date of acquisition, retained earnings as at the date of acquisition? So let us go to the upper part. Now the retained earnings was 3,200. We have it here somewhere here. Here it is 3,200. 3,200. Now give me the figures for that one. So itakuwa ni, it will be 6100 minus 3,200, then over with 20%, that is around 580. That is the post acquisition. That is the post acquisition profit. Then depreciation under charge. There was no any depreciation under charge. Depreciation what? Depreciation overcharge. Sorry, it's supposed to be depreciation overcharge. There was no depreciation overcharge because there was no transfer of asset. So remember, when we have the transfer of asset, or transfer of fixed asset from one company to another, we shall have what we call the depreciation overcharge. In this question, from this working, we do not have anything to do with transfer of asset, but there was depreciation undercharge. That is sale of this one, the valuation. So we need to account for that one. Depreciation undercharge, 20%. So times how much? 200. That is around 40. That is around 40. Remember, that is an upstream. That one is an upstream, if I'm not wrong. That one is an upstream. I think that one is an upstream. Anyway, not an upstream. That one is the evaluation does not have upstream. So sorry for that. Now, we have also UPS. So for UPS, we need to consider UPS for upstream actually. So for UPS, it's supposed to be the UPS for upstream. Upstream means the subsidiary sold goods to the subsidiary sold goods to the parent. So let us see if it was upstream. Let us confirm. Information number 3. During the year, Shape Limited sold goods to Pool. Yes, that's an upstream. So we need to put that amount. The share of the NCI, which is 20%. 20% of the 300. I think that is 60. Then we have goodwill and impaired. Goodwill impaired, sorry, goodwill impaired. Goodwill impaired. Now, goodwill impaired, to pick impaired, it was 20% of the total goodwill. So 20%, 20% of, let me see. So this one, we have it here. We need to add the two. This one, 104, and this one. So how much is that for the two? So 104, it's 104 plus 46. That is, I think, 150. So 20% of 150 is supposed to be 20% of 150. 20% of 150. How much is that? So they are impaired. So 0.2 times 150. Not an impaired, not an impaired. An impaired is as an asset. I think with that one we are done. So you can confirm the format that I gave you. Those are the items that you need, so that the balancing figure becomes the NCI. So NCI to the statement of financial position. So 5700 plus 580, that is 6280. 6280. So we get the balancing figure. So the balancing figure will be minus 40 minus 60 minus 30. 6150. 6150. So this one is 6150. Now we are remaining with one working. That is the working for the retained earnings. That is the working for the retained earnings. I think we shall find a place to do the working for retained earnings. So retained earnings account. Once we open the retained earnings account, that will be the final. Remember, these are the only two accounts which requires a lot of workings. So if you manage to do the rest, even without these two accounts, you can easily maneuver with this question. So you start with the balance brought down from the pool. Balance brought down from the pool. That is the parent. So how much is the balance from the parent for retained earnings? Retained earnings is 13,200. 13,200. Then you need to consider post acquisition profit. Post acquisition profit. Now you consider for the two item. That one is for the subsidiary, that is the Sharp, and for the jointry, that is for the jointry and for the Sharp. Now for the Sharp, the parent is taking 80% because it was controlling 80%. So 80% multiplied with the post acquisition. So we start the balance or the Sharp at the beginning, or at the end. Sorry, the retained earnings at the end. So the retained earnings at the end for Sharp, it was 6,100. 6,100. That was at the end. But at the post acquisition, pre-acquisition, it was 3,200 as the rate of acquisition. This one, 3,200. So we need to less that one, 3,200. Do the same for Sharp. The parent control 50%, meaning it will take 50%. Now the balance at the beginning for at the end for Sharp, retained earnings for Sharp at the end, it was 3,800. 3,800. Now pre-acquisition, we have it here. This one, there is it. 2,500, 2,500. Yeah. Once you have the post-acquisition, we can look for dividend received. We do not have any dividend in this case, but in case you have dividend receivables, any dividend that was received, you put, but in this case, we do not have. Depreciation overcharge, if there was any depreciation overcharge, in this case, there was no any depreciation overcharge. Now we can look for other accounts on the other side. This account is somewhat similar to the NCI. Is that then we put the depreciation under charge. Depreciation under charge. That is not this one will be now 80%. 80% of 200. That is 160. 80% of 200, that is 160. Then UPS also 80% of 300. UPS 80%. So 80%. This one was 20%. So 80% of 300. That is 240. 240. Then we have we can have what we call the goodwill impaired. 50%, 80%. So this one, let me put this here. So goodwill impaired. Supposed to be 80% of 150. 80% of 150. I think that will be equal to 120. That will be equal to 120. Then we have something else. Unwound deferred discount. Unwound deferred discount. That is the interest. This one. So this item here, this one. This item is supposed to affect that account because it will reduce the retained earnings account. So we say unwound deferred discount. Unwound deferred discount. It was 1,000. I think it was 1,000 because 10% of that amount. 10% of that amount. Now, that is all about it with this information. There's no any other account which is affecting this item in this manner now. So once we have that one, we can balance the figure. So 80%, so that one is 6100 minus 3,200 times 0.8. Sorry, 6100 minus 3,200 times 0.8. That is 2320. Let me use a different pen. 2320. 2320. 3800 minus 2500 times 0.5 or 50%. That is 650. So 13,200 plus 2320 plus 650, that is 16,170. 16,170. Then the retained earnings to statement of financial position. The statement of financial position, I'll use a different pen. So we balance the account. So we deduct 160, we deduct 240, we deduct 120, and we deduct 1,000. That will be equal to 14,650. 14,650. So meaning this amount here is 14,650. So let us add them together. So 50,000 plus 5,000 plus 14,650 plus 6150. So it's 78,000. 25,800 Then we add 26 500, 21 300, 13 400, 11,000. Yes, so that one is all about that question. Now, in an exam, even if you don't know how to do this question, you can get free marks. One of the free marks, for example, is make sure you add these items in an exam. You add the way I'm doing. So make sure you do it the way I'm doing. So, for example, this one does not require a work inventory. You know, you take the parent and the group, then you list the UPS. This one is 1 mark, an exam. Yeah. Receivables also does not require a lot of working. You take the parent and the group, then you list the owings. That's another mark. That is 2 marks. Remember this question was had how many marks? This question had 12 marks. Part C had 12 marks. Then the cash and cash equivalent, you take the parent and the group. That's another mark. So you have 3 marks. So don't add the one for. So the one for the total does not count. Share capital is 50,000. Another mark. Share premium, another mark. So how many marks do you have? 1, 2, 3, 5 out of 12. So this one requires a working retained earnings. Now you have this one a mark. You have this one a mark. So make sure in an exam. So long-term borrowing, you just take the one for the parent and the one for the subsidiary. Same to trade payables, you take the one for the parent and the one for the group. Then you rest the owings, the intergroup owings. That one is okay. Current tax the same. You add the one for the parent, the one for the group. Purchase consideration is even simpler because you know that our deferred amount was 10 million. Then you add the interest, which is 10% of that amount. Also, that's a mark. Now, how many marks do you have? 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 out of 12. Now, make sure you have those 9, 12. 9 marks. Before even you try to do the NCI and the retain earning account. So, in an exam, what I will advise you is that you check on your incomes, your items that are there in the balance sheet. So you start with you start with the PPE if there is a PPE. If there is investment in subsidiary, you replace it with the goodwill. Investment in associate or in joint ventures, you put investment in associate or the joint venture, whichever it is. So in this case, there was investment in joint ventures, you put them. Without putting the amount, you go to the current asset, you put the inventory available, all the current assets available. For equity, you put all the items available. But remember, you add one account. Which account? You add the account which is called the non-controlling interest. So in your question, the answer will not be there, but you just add it without putting the total. Then non-current asset, you put the non-current asset. Then you put the non-current asset available. Then the current liabilities, you put all the current liabilities available. And then you check if you had the deferred consideration. If there was any deferred consideration, some questions do not have deferred consideration, but in this case there was. If there is no any deferred consideration, you don't put it. Now, once you do that one, check the account which are not affected that much. For example, the borrowings. You just pick the one for the parent, for one for the group. You just pick and you put. That is 1 mark. You put for all those items. Then the others that are remaining for PPE. For PPE is simpler. For PPE, you just check. I gave you a format. So you check the account which affect the PPE. So you add the parent and the one for the parent and for the subsidiary. You add the devaluation and you less this depreciation under charge and anything else which affects that account. You put it. So, but in this case, if there is transfer of fixed asset, remember transfer of fixed asset will affect this account. So, but in this case, there was no any transfer. So, any transfer of fixed asset, any item which affects this account, you incorporate. Then that one will get your mark easily. The goodwill and the other one, you can get your mark easily because they do not have any debt. Now, they usually pick any 12. So, even if you have this wrong, even if this one is wrong, but the rest are correct, they will pick any 12. So, they will add 1, 2, 3, 4, 5, 6, 7, 8. This is wrong. For example, 9, 10, 11, 12. They will pick any 12 that is correct. So make sure you start with the most simplest. You make sure you scoop this simplest question before you go to the complex, the NCI and the retained earnings. For goodwill and investment insurance, that one is simple. That one is very, very simple. So I think with that one, I want to wish you well. We shall meet and do another question in our next class.